Hello, and welcome to the Weekly Watch podcast series. I'm John Briggs, Global Head of Desk Strategy. This series helps you cut through the noise of global financial markets with a quick take on the upcoming trends to watch. Hello, everyone. This is one of those tougher podcasts to record because it's being done just one day before a very important event, which is the non-farm payrolls report in the U.S. This number is going to go a long way to determining whether the Fed is on track to taper along our timeline or not. And as a reminder, our timeline is that the Fed at the September meeting, which is on the 22nd of September, will give some sort of signal to tee it up to provide that adequate notice that they've said that they would provide for a November announcement and then a start in December. Now, there's still some flexibility around that. If we have a very strong or very weak number, the Fed has not locked themselves down into a specific timeline, so we could see that move around, but that's our baseline. And we expect that the data, if it comes in anywhere in the 450,000 to 900,000 range, probably keeps that on track. Anything above that, we could see yields move meaningfully higher, led by the US, but also globally, given the importance of this number, and the US dollar could strengthen. Less than that, the reverse is true. But higher pressure on rates so far in September in the US may not be the only story. We've recently seen moves higher in both UK gilt and European bond yields. And the latter has been caused by hawkish ECB council members that have been weighing in of late, putting upward pressure on the market there. And to some degree, it's also helping anchor the euro against the dollar. In fact, on a broad basis, our FX team is actually considering whether there is a general momentum shift in growth and policy expectations that could point towards a higher euro. Though, of course, with the non-farm payroll report, the September Fed, the dollar impact on that side of the coin still looms large. Where we do have high conviction on momentum favoring Europe is on the growth side. So here to talk about that and the ECB, which is coming up next week, is our chief European economist, Giovanni Zanni. So Gio, thanks for joining us this week. First things first, last time you were on, you were quite optimistic, and let me say more optimistic than consensus on the growth outlook for Europe. How's that playing out so far? And do you have any change in views or still pretty positive?
Hi, John. Hi, everyone. So we've been actually a low consensus since the beginning of the year. And it's paying off because the consensus is moving in our direction. And I would say also the ECB, they already moved higher in June, but, and we've seen the kind of declarations and comments from ECB officials. They are going to raise further their GDP forecast next week. Of course, there are risks, Delta variant, especially outside of Europe, actually, and also the fact that you have supply bottlenecks that are putting a brake on activity, and that's for sure. I agree with all that. I'm just saying that I'm seeing that demand is strong, continuing to be strong. And actually, if you look at the kind of pent-up demand, the demand that could come from the return of consumption of services, and in front of that, the fact that the saving ratio, especially in Europe, is still very, very high. In the US, it has started to kind of normalize faster in Q2, but in Europe, in Q3, it was still very, very high. And so for me, there is ground for sustained growth, not just for the next couple of quarters, but for quite a longer period. And I would say just one final thing is that even if you look at longer term, I think that the consensus is still a little bit inconsistent or out of line, because all the number I see also from the IMF, for example, or the professional forecaster, is for a growth that is very similar to the average growth that we had pre-pandemic. Also for the longer term, I think the consensus is a little bit behind in the thinking, because if you look at the IMF and all the forecasts that you have from professional forecaster, they take the future growth very similar to the average growth that you had before the pandemic. But frankly, I think that there's an innovation, and it's the fact that we are finally using the fiscal instrument, something that we were not using before. And so for me, growth will be probably something like a 0.5 percentage point higher annually for the next 5 to 7 years. And so that's something also that should be taken into account.
Yeah, and I think that, something that you've also talked about, and just to remind listeners, is we are still starting to get that fiscal stimulus from the European Recovery Fund. Again, talking about relative growth momentum, and U.S. additional fiscal stimulus plans are a little tied up in politics, but with that fiscal stimulus hitting at the same time with that savings buffer, it certainly seems like that all adds up pretty well. So set us up for the major event for the coming week, which is the ECB meeting on Thursday, which is the 9th. So a lot of hawkish ECB speak lately. Do you think there's a representation there for the broad committee, or are we only hearing from the hawks and one side of the council of late? What's your expectation for the meeting?
Yeah, that's a good question. If you look at the Frankfurt skies, you probably see all these hawks circling of the ECB. No, they don't represent, of course, the kind of central view of the governing council, but there is something to it. I mean, something is moving on the kind of average or mean view of the council, for sure. We had this speech from Lane, the chief economist, who is a clear dove in the ECB council. And actually, there are two things that are really important. First of all, is that on the the growth side, I already mentioned that, so there will be an upside revision, but it's also true for inflation. So inflation is being revised up, and not just for temporary factors. First of all, because all these kind of bottlenecks are, temporary, but persistently temporary in a sense. So it's something that will last for a bit longer than anticipated before. But there's also this idea that the stronger demand that I mentioned, and that is now becoming consensus, is something that is affecting as well the views on inflation medium term. So I expect even the kind of 2023 number to be revised up to, let's say, 1.6 from 1.4. So we're still, below target, etc., but we're definitely moving in a kind of normalization direction. And then the other point is, of course, financial conditions in general. The reason why the ECB moved to this kind of a significantly higher pace of PEP purchases is because at some point early 2021 we had an increase in rates, and the situation also on the broader financial condition was starting to worsen a little bit, and so there was a reaction to that. Now, if you look at nominal rates, they've come down, and of course they're not back to where they were in December exactly, but they're very close to that point. If you look at real rates, which are probably the most important indicator, the real relevant one, they are clearly below the December level. So we are close to a nirvana in terms of financial conditions. So at this point, I think it makes sense to at least remove the significantly higher refrain. The ECB is prudent, is patient. They've said that. I think that they mean it. And so I don't think that the reduction will be very large. My view is that it will move from probably around 80 billion that we've seen so far to something at 70 billion, maybe like a few billion less, but not more than that. So still above what we had at the beginning of the year. And also, I think that they will basically reclaim their flexibility, which is the key point there, because of course, purchases are not a kind of absolute thing. It's related to demand, it's related to net supply. So there's a lot of factors, and the ECB doesn't want to upset market, doesn't want to have any kind of repercussions, especially not on spreads, etc. So, at some point they might even buy again in quantity even more than they are buying now. So I think that the kind of flexibility point will be even more important than the idea that, maybe it's time to kind of start to reduce a little bit the pace. The last point, I don't think they will discuss this at the meeting next week, but there were some questions to Lane in the interview last week, and there will be, of course, at the Q&A session. Next week is about PEP exit or a QE exit, and there we put out a kind of scenario which is related to our expectation for a rate hike in late 2024, beginning of 2025. And so in that context, it makes sense to have a progressive reduction to zero by that time. So we're talking still almost 3 years, like definitely more than 2 years of QE in a progressive reduction. So I think that will be the kind of context for the ECB next week. I don't think that there will be much else in terms of other instruments, because it's really not the point. The point is about this idea that normalization is consistent with a progressive idea that PEP could at some point be removed and then replaced by a progressive reduction of the more general QE. Still mean like 500 billion more envelope of QE in the next few years. So it's still quite supportive.
Yeah, so taper, but not really. All right, great, Gio. Thank you so much. That's all the time we have for this week. Hope everybody has a good week and good luck. I hope you have enjoyed this episode of the Weekly Watch. Please subscribe to our channel to get future episodes. We also encourage you to explore more of our content on our website and other social media channels.